This chapter tries to explain some of the anomalies that we see and also talks about how you can potentially take advantage of some of these monopolies or behavioral biases that we will also discuss. I believe there are two papers that you guys are going to be presenting that are on this topic, one on behavioral and one on technical. So the conventional finance that we normally study and that you've been studying all along says that prices correctly reflect their intrinsic value or their dividend discount based value based on all available information, and that they change quickly when new information is released, consistent with the efficient market hypothesis. They also hold that you can't necessarily predict what that future information is going to be. It just kind of comes up. We can't predict what's going to happen from one day to the next. I mean, no one really expected that school would close down and everything would be online. These things are hard to expect. So that's consistent with the random walk idea. And all of that is based on the idea that investors are truly rational. So anytime you get any new information, you automatically update it. But are people really rational? Do we all look like this dude over here, like 100% rational, 100% focused on money? Something costs more. We consider the marginal utility of each bite of our cheeseburger so that we never overeat. We never do impulse buys on spending. No, people don't behave like that. So what behavioral finance tries to do is figure out, okay, so how are we irrational? What things do we do that cause us to behave irrationally? And then how does that impact stock prices? So investors don't always correctly process information. The result is an incorrect probability distribution of future returns. Well, what does that mean? It means that we tend to over or underestimate future return distributions, meaning that they become skewed in one direction or another. So it can be skewed positive. If you hear some positive news, you then overestimate what the future prices are going to be. You skew more to the positive direction so that you'll see prices overreact and then come back down to normal over time. This could be used to explain price drifts, overreaction and correction, momentum, those kinds of things. The reverse would go for, bad news. You hear bad news, the stock price drops dramatically in one day, and then there are people, that it starts to recover or it continues to drift back down. And the other section is that we have common behavioral biases that can become predictable. So when given a probability distribution of returns, investors may make inconsistent or suboptimal decisions. So there are common behavioral biases that we all exhibit that come from psychology and that have an impact on the purchasing, spending, investing decisions that we make from day to day. So these are the information processing errors that they're talking about. These are the ones that fall into the first category. The first one is forecasting errors. So too much weight is placed on recent events. That's what a forecasting error would be. Now, the studies that you see in psychology, one of the ones had someone go and do a spinner, play around with a spinner, like a roulette wheel, and it has, the higher the number the person spun, the more likely they were to name a larger number when asked a random question. So you would, someone spins a high number and then is asked, what is the number of countries in Africa? And they would end up saying a larger number than someone who had spun a small number, even though obviously those the random number that you spin on a roulette wheel and the numbers of countries in Africa are completely unrelated. This is one of the studies that is discussed in there. So one of the things you will see where we see this happening is the PE effect that we discussed earlier. So the PE effect can be explained by earnings expectations that are overly extreme. So we see that these certain companies are performing well. Their PE ratio is going to be significantly higher. So then we overestimate the earnings as a result of that and expect it to continue to go higher. The next one is overconfidence. So this means that we overestimate our abilities and our precision in making forecasts. So there's one famous study that's where they come out and they ask drivers, a certain number of drivers, how many of you are confident that you are a good driver or better than 50% of other drivers on the road, and 90% of people said they were better than 50% of other drivers on the road, I mean, obviously that's going to be impossible. So we tend to be overly confident. What are you doing? Okay. So this can lead to over trading or sticking with an idea longer than you should. Like, you have a trading concept, Ezra put it down, you have a trading concept that you think is a good idea, and then you end up sticking with it even though you start to lose money and you see that it's no longer going to be valuable. The next one is conservatism. Oh, hold on, I thought I paused it to yell at my kid. Give me a second. Sorry. The next one is conservatism. So investors are slow to update their beliefs, or they underreact to new information. This can be one of the explanations for the momentum effect. So, example, this coronavirus, right? Yes, we heard about what was going on in China, and we thought, okay, well, yes, I'm sure it's going to come here, but did we really expect it was going to come here this quickly? I mean, everyone was surprised when school shut down. I'm sure people are surprised when it was announced yesterday that statewide all the liquor stores are closing. Oh no, what will we do? The horror. So this information is coming out. We know about it, but then we're slow to react. We're slow to incorporate that new information into our expectations. So you see that same thing occurring in stock prices, which might be one of the reasons that you see that drift even after an announcement. Ezra, I still see you. The next one would be representativeness. So investors are too quick to infer a pattern or a trend from a small sample size. So, you know, in statistics, they say you need to have at least 30 for the law of large numbers to come in and for this to be showing a real, be able to understand for statistical significance. When you're dealing with stock price numbers, it needs to be even higher than that. So many people will argue that some of these technical analysis things that we're going to talk about, patterns and stuff that happen in the future, patterns that happen, we are going to talk about them later in these slides, that people will look at them and infer a pattern too quickly without going back and looking at a full sample of data, say maybe 10,000 observations, especially if you're dealing with intraday data, which is what most of these charts do. Then you would see, oh, well, that's not really a pattern. You can only see a pattern when looking back over time or something like that. Okay, the next set of sections relates to the second set of irrationality. So these are the common psychological biases. The first one is framing. So with framing, how risk is described can impact an investor's decision. This is the idea, this is where advertising really comes in. How do you present something? Do I present it as a risk of loss, or do I present it as a risk of gain, right? So people are influenced by the advertising of things, by the way things are framed, by the way things are discussed. So you can make things look good. This is where you would see people, quote unquote, lying with statistics, not really lying, just giving you information, but saying it in a different way. The people are susceptible to this. So this framing has been used as one of the explanations for maybe why we see the common pattern in IPOs where the price shoots way up and then it drifts down to a fundamental level over time. That's something interesting. Mental accounting is another one. Mental accounting is the idea that investors may segment accounts and take more risk with their gains than they would take with their principal. So the idea is that it's irrational for you to have a conservative savings account and then a day trading account and then your kid's 529 plan and then your retirement fund and all of these things all separated into different silos or different mental accounts, and put different amounts of risk into each of them, or be willing to accept different amounts of risk. So the classic idea that I always use is a day trader. So a day trader who's constantly taking positions, taking risks, every day that's legit their job, that's all they do is trade, and then have a conservatively invested 529 plan for their child's college education, right? Those two things don't match. They don't mix. The argument would be that from classical finance that people have one common degree of risk tolerance that should be applied to everything. So think about time value of money and building interest, right? You know, the higher the principal value, the higher the present value, the faster interest will grow, even if the interest rate is, you know, a set amount. So earning 10% on $100 is a lot less than earning 10% on $10,000, right? So why keep your money in each of these individual silos? If your risk tolerance is 10%, then you should be all in at 10%. In order to really experience the benefit of that compound interest. Now, in reality, it's really hard for people to do that. We've been conditioned to say, you know, this is my money that I'm setting aside for my retirement. This is my money for my kids' college education. This is my money to buy a new car. This is my money for vacation. So we do this on a regular basis. But from a fundamental perspective, people would argue that that does not make sense. The next two kind of go together, regret avoidance, which leads to prospect theory. So regret avoidance is the idea that investors will blame themselves more when a risky bet loses than they would when a safe bet does. So this might explain the market to book effect, or the HML, or sorry, small minus big, high minus low, explain those ideas. So it's the idea that there's safety in numbers. You don't like to make mistakes. You're worried about making mistakes. So you're worried about taking a risk, or you're more worried about taking a risk that no one else is taking, that you're the only one taking, rather than taking a risk that everyone else is also willing to take. So the argument here would be, I'm not going to invest in a small fund or a small firm that's really risky, even though I feel like that could be a good bet, because if I lose, I'll feel foolish. Clearly, no one else was investing in that firm because everyone else saw that it was a potential problem. So I should think that way too, and I shouldn't invest in that, because if I invested in that and I lost money, I would feel super bad. Whereas this slightly larger firm that also has the same amount of risk, well, this is a big firm. People are also investing in that. If that were to tank, I would still feel bad because obviously I lost money, but I wouldn't feel as bad, as foolish, because other people were also making that mistake. So this is one of the ideas why that HML, that high minus low, that market to book, market value to book value ratio, why that comes into play is because people are shying away from that potential for regret. So they don't want to invest in the more risky stock. Mental accounting can also account for this. People will say, okay, well, I'm only willing to play with, say, 10% of my money, quote unquote, play with. So I'm willing to take more risky investments on 10% of my money. Well, you would put aside a smaller amount of money to play with, to take more risk with, in order to avoid potential regret, so that those two kind of reinforce one another. You don't want to regret a bad choice, so you would put less money into the risky assets so that you didn't end up making a huge mistake, that kind of idea. This also relates to prospect theory, which is something that you learn about in psychology. And it also focuses on regret. So that's what these two graphs here are looking at. So the first one is our utility relative to wealth. And this is the general idea that as you get more money, you are more happy, but it increases at a decreasing rate over time. We never really top off anywhere or see a downward trend. We just realize that it increases at a decreasing rate over time. So more wealth equals more utility, more happiness. Well, down here we see this rewritten for prospect theory, and you see that it's a sinusoidal kind of function. It's not concave over the entire wealth surface. So you do see the concave over positive wealth, but over it's convex over negative wealth and negative utility down here in quadrant 1, 2, 3. This is quadrant 3. Sorry, I have to remember a little math there. Okay, so the idea here is that utility depends on changes in current wealth, not just regular wealth itself. So the way to think about this, the pain of a loss hurts more than the pleasure of a gain of the same magnitude. The pain of a loss hurts more than the pleasure of the gain of the same magnitude. In other words, gaining 5% might make you happy, and if you measure that certain degree of happiness, that would give you, say, 1 udel. But losing 5%, right, causes you to be significantly more, losing 5% of your wealth causes you to be significantly more upset. So because we try to avoid losses. Losses hurt us a lot more than a gain would. Well, obviously a gain would make you happy, but from a symmetric point of view, gaining 5% gives you a certain amount of happiness. Losing 5% gives you a disproportional amount of sadness, so that your utility function is not symmetric over gains and losses. That's the way you hear it often phrased. Your utility function is not symmetric over gains or losses. The pleasure of a gain is less than the pain of a loss of the same degree. Okay, so efficient market people will have a counter argument to this. They'll say, yeah, there can be people who have behavioral biases. Sure, people have them, but the market as a whole is smart enough to detect these, is smart enough to recognize these and see these, so that the behavioral biases of some market participants don't matter and would end up being called quote-unquote noise traders, as long as rational traders are able to spot them and arbitrage away. So the argument would be, yes, please keep studying these behavioral biases so we can find them, so you can point them out to us so we can prevent ourselves from doing them, and also be on the lookout for them, spot them, so that we can make back more money from that we can trade, take the opposite side of a trade based on that. So the academic literature keeps going. It keeps evolving back and forth between the fundamental side and the technical side, with anomalies being pointed out, behavioralists trying to explain these anomalies, and then people coming in with trading strategies that say, okay, if this happens, here's what we should do, which is why you see from the previous lecture when we were talking about mutual fund managers actually using the Carhart model, which is the Fama and French 3-factor model plus a momentum factor. So people saying, yes, I realize that these behavioral biases exist. I realize that these anomalies exist, but let's try to find a way to exploit them or to price that information in so that it becomes exploitable. So those that are trying to exploit these oftentimes will follow something called technical analysis. So technical analysis tries to exploit recurring predictable patterns in stock prices, for example, like a stock price drift, right? You see that there is a drift or momentum, a continued movement in one direction, you'd bet on that movement. The disposition effect is the idea that investors tend to sell their winners and hold on to their losers. Again, this is consistent with regret avoidance. So I might have a stock that I thought was going to do really well. It starts doing poorly. You'll, instead of realizing that loss by saying, okay, do a stop loss order, sell it, and realize that loss, be down that amount, people will tend to hold on to it longer thinking that it will recover, when in reality, that information is coming out that you should not do that. So this can lead to momentum in stock prices, and that momentum can be tested using moving averages, and the idea is that you would be able to exploit this through technical analysis. So we're going to talk about a couple, just one primary technical analysis factor, which is going to be called the moving average in momentum. So a moving average is the average level of prices over a given time interval. So in this instance, it's a 50-day moving average. So what does that mean? What do they do? Moving averages are used to smooth out a trend so that you can spot the trend more easily. So this is just a snip from your textbook. You can see it's showing jumping around. These are the daily closing prices in the black line in A, and then the blue line is the moving average in there. Oh, sorry, that went back. So it's kind of weird, the way that it has it stated is opposite. The moving average is the blue, and the actual daily is the jumping around. So there is a mistake on the way that it has that phrased in that key right there. Okay, so how do you find a moving average? You would look, say, if this is the last 50 days moving averages, it would take the closing price on the previous 50 days, so 50 days worth, and do an average, and that would be one piece of information. Then it would do the next 50 days and that new piece of information. So you'd be able to find this moving average smoothed out over time, but that first 50 days, once it's used, then you move down one to use the next 50 days. So I'll show you a numerical example of how you would calculate that. But the goal is that it would create a more smoothed out trend. And then one of the keys that people look at is when the market breaks the moving average, it's considered a buy signal. So when you're down here, you see this, here's the actual trading. The moving average was above, then the market jumps up above that moving average. That would be considered a buy signal, and then it continues upward. So people would argue, oh, this is clearly good. Obviously, the stock was doing really well. And vice versa, they'd say anytime the market crosses the moving average, it's going to be a downward signal that the stock price is going to go down. Now, how do they explain these movements? And you know that these patterns didn't continue? Oh, they'd say, oh, that was just short-term noise. So you can see the argument back and forth from both sides. Some sides saying, yes, this is a really clear signal, and other sides, you know, the fundamentalists saying, no, that's just, you made some pretty charts. So that's kind of something to look at. Now, technical analysis people would say, all right, well, we won't make it just based on that one indicator. We would go for several other indicators. So there are indicators in terms of chart patterns that people look for. You can see something called MACD lines, which relate to moving averages, but then have information above and below, or 2 standard deviations above and below a moving average. So that will smooth out and show you how much noise you could expect to see in there. And then you would examine, I'm only going to see that as a legitimate signal if it crosses the upper bounds of the MACD lines. So you can see that. You will also see people looking for other patterns or other sentiment indicators, volume of trades, things like that, that would support these movements. So 2 of those sentiment indicators that you can look at to help establish the trend. So sentiment in general is, how does someone feel? So market sentiment, you know, are you feeling bullish? Are you feeling bearish? Are you feeling happy about the market, or are you feeling sad about the market? The trend statistic is a calculated statistic that uses market volume to measure the strength of a market rise. If there's an increased investment during a time of market advance, it's seen as a strong signal of the significance of the movement. So if you're seeing more volume going into money or going into the stock than going out of the stock, more people want to buy than want to sell, right? Then that's supporting the idea that there's something to this, that the stock should be going up, and you can bet that momentum will continue. That's one of the things people will look at. Another sentiment indicator that you will often see quoted is the put to call ratio. So a put is the right to sell, and a call is the right to buy. So you should expect the put call ratio in general to be less than 1, because people tend to want to buy stocks. People tend to be more optimistic over time. Say hi. Okay. Ezra, call is the right to? Good job. Okay, now go away. All right, so if this ratio ends up being greater than 1, then people are going to be feeling more bearish. They're saying, well, listen, more people want to sell than want to buy. So the put-call ratio is legit just the number of puts sold on a stock divided by the number of calls sold on that stock. So if you're buying a call, you're betting on the stock price increasing. If you're buying a put, you're betting on the stock price decreasing, right? So if you start to see more puts than calls, meaning this put to call ratio goes greater than 1, then that would be a sign that you expect this stock price to decrease. So some of you are going to be presenting papers looking at stock price patterns, and others are going to be presenting papers on some of the behavioral biases that we have discussed.